Assalamu alaikum, dear students. Hope you are well. I am Mohammad Samad Khan, lecturer, Department of Accounting, Dhaka College, Dhaka. I am going to take an interesting class. Today, the topic is financial leverage and capital structure. Okay, dear students, so let's start our class. Okay, first of all, we have to know the capital of a company. I mean, capital of a company or corporation may be collected from a single source or double source or triple source. Okay, first of all, I want to say capital of a company or corporation may be collected from a single source, through ordinary share. Through ordinary share or common share is known as equity capital. Is known as equity capital or capital. Okay. Then the company or corporation may be collected capital or funds like from bond or debenture. Okay. It is called or it is known as debt capital. Okay, sometimes we are collecting capital from preferred stock or preference share to build capital structure. It is called hybrid security. It is called preferred stock. It is called hybrid security. Okay. Why hybrid security? Hybrid security because for its characteristics of debt and equity. Okay, so we are called hybrid security, the preference share for its characteristics of debt and equity. Okay. To use of debt or sometimes preference share in association with common share or ordinary share to build capital is termed as leverage. Standard leverage or financial leverage. Okay, dear student, we say that what is leverage or financial leverage? Simply, we say that use of debt is financial leverage. Simply, use of debt is financial leverage. Okay. Here, we are see that to use of debt or sometimes preference share is association with common share to build capital is termed as leverage or financial leverage. Simply, use of debt is financial leverage. Actually, when we use debt or bond, when we are use debt or bond in an institution, it is called leverage. Okay. So we know that what is leverage. I mean, leverage is that when we are use debt in the financial institution. Okay, whenever we are use debt in financial institution, we are decreasing the weighted average cost of capital or increase the value of the firm. Okay, dear students, later we are going to learn something else. Okay, okay, students, here formats of capital structure. Formats of capital structure, we see that first of all, one, single source capital structure. Okay, single source capital structure. I mean, single source capital structure. Okay, see the specimen capital and liabilities. Okay, XYZ company. Okay, capital and liabilities, say equity capital. Okay, accounts payable. Okay, provision for taxation, say okay, say equity capital, say 5 lakh. Okay, accounts payable 1 lakh and provision for taxation 1 lakh. Okay, it is total summation of 7 lakh. Okay, the student, then property, asset, some we are say goodwill or plant or equipment or building, etc., etc. Account receivable may be another else. Okay, it should be 7 lakh. Okay, good. Here it is single source capital structure. Maybe we are see another two. Please see two double source. Say double source capital structure. What we are seeing in double source capital structure as like that equity capital with say bond or debt. debt 10%, say 2 lakh taka. Okay, good. Okay, it is like double source capital structure. It is one of them, and then another will be debt. Maybe debt in the exchange of debt. I will be writing here preference share or preferred stock. Okay, preferred stock. Okay, good. So here we are seeing that double source capital structure is like two. Okay, one is equity capital with debt, or then another is preferred stock. Okay, then triple source capital structure. Triple source capital structure. What will be in the triple source capital structure? Triple source capital structure, we see that with equity capital, we see that two of them are here, like debt and preferred stock. Okay, debt and preferred stock. Debt and preferred stock. Okay, formats of capital structure. Good. Okay. So we have already known the formats of capital structure. Formats of capital structure is like three kinds: single source, double source, and triple source. Okay, dear student, objective of financial leverage. Objective of financial leverage. Financial leverage is a tool used with the following objective. Okay, first of all, to reduce weighted average cost of capital. Okay, to increase value of the firm. Okay, 3, to increase value of the equity. Okay, then 4, to increase return on equity. Okay, here we see that the 4 objectives are here: to reduce weighted average cost of capital, to increase value of the firm, to increase value of the equity, and then last one is to increase return on equity. Okay, dear student, at first we are going to discuss first one, to reduce weighted average cost of capital, or reduction of weighted average cost of capital. Okay. Okay. Here, to reduce weighted average cost of capital, here always that is that is less costly than equity. And you should know that that expense is tax deductible. Okay. Here we know that is less costly than equity, and that expense is tax deductible expense. That is tax deductible expense. So more use of debt reduces weighted average cost of capital. So we realize that whenever we use more debt, we reduce weighted average cost of capital. Okay, good. Okay, we are trying to solve a problem now about the weighted average cost of capital. Okay, dear student, now I write a question here. Say ABC Limited has the specific cost of capital of the debt, equity and preferred stock of 8%, 16% and 10%. Okay, and value of these sources of capital are taka 5 lakh, taka 10 lakh and taka 5 lakh. Then WACC, I mean weighted average cost of capital, is as below. Okay, dear student, I hope you are write the question in your script. Okay, we are trying to solve the question. Okay, here what are we seeing this question? This question has three things. I mean debt, equity and preferred stock. Debt 8%, equity 16% and preferred stock 10%. Okay, and value of the sources of capital are taka 5 lakh. Value of the sources of capital. You know, this is the source. This is the source of capital. This is the source of capital. This is the source of capital. Okay, we are say here that triple source of capital. Okay, debt, equity, and preferred stock. So here we see that 5 lakh is debt, 10 lakh is equity is 10 lakh, and then preferred stock is 5 lakh taka. Okay, table of overall cost of capital. Okay, dear student, sources of capital, then say amount weight cost, okay, and weighted cost. Okay, source of capital, debt. First is debt, amount 5 lakh, then equity equity 10 lakh, and then preferred stock 5 lakh. Okay, total gross 20 lakh. Total 20 lakh. Okay. Weight. Here weight is 0.25. I mean fraction. What is the fraction? That is what is the fraction of total amount. Okay. So here 0.25, 0.50, then 0.25. Okay. So cost. Okay. Say cost of debt, KD. Cost of debt. What is cost of debt? Cost of debt equal interest divided debt or debenture, okay, into 1 minus tax rate. Say assume a 50% tax rate. Okay, 50% tax rate. Say, okay, then interest, how much interest? 5 lakh into 8%, that is, say, 5 lakh into 1 minus 50%, okay? So, if we count that, here, we'll count it 5 lakh into 8%, $40,000 taka divided 5 lakh into 0.50. Okay, then .04. So it is 4%. Okay, so here cost is 0.04. Okay, then Then equity. Okay, equity. Here, equity, we say that KE, cost of equity is 16% here. Okay, say 16%. There is no retention or growth rate. Okay, there is no retention and growth rate. KE actually it is formulated by E1 by P0 or PO. Here E1 means earning per share at the end of first year. PO means initial price or selling price. Okay, good. So here 16%. Here we can say that 16 taka by 100 taka. I mean 16%. Okay. Okay. Then 16%. Okay. So 0.16. Then preferred stock. Okay. We are bring out the preferred stock as KP, preferred stock. Okay. So KP, certain dividend is declared so that here KP is constant. Actually, preferred stocks dividend are always constant. So KP here constant. So KP is 10%. Okay. So 10%. Okay. Or say it is formulated by preference dividend by preference capital. Okay, so preference dividend, I mean 5 lakh into 10%. So here is preference capital is 5 lakh, so 10% here. Okay, so 5 lakh into 10% by 5 lakh. Okay, I mean 0.1, I mean 10%. So 0.1. Okay, so we see that 0.25 into 0.04 equal 0.01. Then 0.50 into 0.16, it's 0.08. Okay, 0.25 into 0.10 equal 0.025. Here summation. Okay, weight 1. Summation 0.25 into 0.08 plus 0.01. Okay, here 0.115. I mean total weighted average cost of capital, weighted average cost of capital is cost of capital is 11.50%. Okay, dear students, we will discuss the increase or maximum the value of the firm, and then increase the value of the equity, and then increase the value of the return on equity, we will discuss next class. Okay, thanks.